In this video, I'm going to walk you through the class handout from Saturday, April 7th. This handout will also be posted on Blackboard in the course materials page in the section titled Saturday, April 7th. In class, you were given time to work through this worksheet, and if you did not finish, I asked you to complete it before we meet next time on Saturday, May 5th. I'm going to analyze the financial statements of Kimberly-Clark using the company's most recent 10-K, which was issued and filed on February 8th, 2018. In order to find the company's 10-K, I'm going to search on Google for SEC Edgar Company Search. I'm going to click on the link for Company Search and put in the company's ticker, KMB. I'm going to search for the filing type 10-K, which is the annual report. And once that comes up, I'm going to click on the Interactive Data button to get the data that's easily viewable and easily downloadable into Excel. Once this comes up, I'm going to click on the financial statements, and I can start anywhere on the financial statements. As I answer the questions that are on the handout, I'm keeping in mind that I'm trying to gain an understanding of the company's financial position at 12/31/2017 and the company's financial performance over the year. We also want to see how the financial statements articulate or are connected to one another. And we want to start comparing the value of the company's stockholders' equity on the balance sheet, or book value, to its market value. And we want to start to consider ideas about why the company's market value may differ from its book value of equity. Question 1, Part A, asks for the accounting equation. I go to the balance sheet. Sometimes it's called the Statement of Financial Position. You might see that on the company you're looking at. Click on the balance sheet. And I see that assets are equal to $15,151,000, and equity is equal to $882,000. I can easily back into the total liabilities number by taking the difference between 15,151 and 882, and I can check that number by calculating the sum of total current liabilities plus all of the debt and the redeemable preferred securities of subsidiaries. I see that the company's assets are very heavily financed with debt. This could be a bit risky, but Kimberly-Clark is a very mature, stable company, so I probably don't need to be too concerned. Question 1B asks for revenue, expenses, and net income, so I go to the income statement. Right now I'm looking only at 2017. I see that revenues are $18,259,000. I see a lot of expenses and a lot of other data. So I scroll down to the bottom and I see that net income is $2,319,000. So I can easily back into what those total expenses might be by taking 18,259 and subtracting 2,319 and calculating expenses as 15,940. I can confirm this by adding up all of the expenses I see, such as the gross profit, marketing expenses, other expenses, and so forth. Just keep in mind that sometimes firms will report other revenues and other gains below gross profit, which can be considered additions to revenue account or offsets to those expenses shown in the income statement. Question 1C asks you to find operating income. Operating income is frequently reported as a line item on the income statement, sometimes directly as operating income or operating profit as you see here, and sometimes as earnings before interest and taxes. That classification typically is referred to in the popular press as EBIT. Kimberly-Clark reports revenues of $18,529, as we see here, and operating income of $3,299, as we see here, so I can easily calculate operating expenses as the difference, $14,960. What have I learned about Kimberly-Clark so far? The company has net income of $2,319,000,000. Net income is primarily from operating income, and operating income is the most sustainable part of income. If a large part of the company's net income had come from a gain on the sale of investment securities, I would worry about the sustainability of net income. But in this case, I'm not. I also noticed that the company produced net income of $2,319,000 off of assets of $15,151,000. This works out to be a return on assets of about 15%. You don't need to worry about doing any calculations at this point, but we're just kind of comparing the two to see that the return is quite good. Question 1D asks you to reconcile operating income to net income. Here we see operating income of 3299 is increased by 10 million of interest income and decreased by 318 million of interest expense and 776 million in income tax expense. The company also reports share of income of equity companies right here of 104 million. This means that Kimberly-Clark has influential but not controlling investments in other firms. And again, we're talking only about this item here, share of net income of equity companies. The interest that Kimberly-Clark has in these equity companies must be between 20 and 50% of the ownership. The accounting rules require that the company does not have to consolidate with these company shares that are being owned, but it just has to report the equity ownership and income as a proportion of the investee's own earnings. So what can we take away from this data? Operating income of $3.3 billion is reduced by about 1.1, which is primarily coming from the tax expense. This is not unusual. Most of the company's income is coming from operations, which is a sustainable method of earnings. Question 1E asks for the breakdown of net income into the portion attributable to the reporting entity, as we see here, Kimberly-Clark, versus the portion attributable to the non-controlling interests. When a company, in this case Kimberly-Clark, which can be referred to as the reporting entity, purchases a significant investment in the common stock of another company, where the accounting rules define significant as 50% or more of the acquired company's common stock, the acquiring company, in this case Kimberly-Clark, must consolidate all of the financial statements of the subsidiary together with the acquirer's own financial statements. So what's the problem? The parent company, in this case Kimberly-Clark, does not own 100% of the common stock of this subsidiary. Therefore, the parent company's common stockholders do not own the full 100% of the net income that is reported here, the 2319. So while the revenues are included for both all of Kimberly-Clark and all of its consolidated subsidiaries, only one line, this line here, net income attributable to non-controlling interests, is the net impact of the portion that is not owned by Kimberly-Clark's stockholders. Question 1F relates to the statement of cash flows. So I'm going to switch over to the consolidated statement of cash flows here, and it asks us to look at this net change in cash that I see here of 307 million. How do we break that down into the three major components? I see cash from operating activities as 2.9 billion. That's positive. Clearly, their revenues from customers are much greater than their expenses of running the company. That's good. Not surprising for a mature, stable company like Kimberly-Clark. I look at the cash from investing activities. I see the company had a net cash outflow of $851 million for investing activities. This came primarily from capital spending, meaning purchases of plant, property, and equipment. The net cash from financing activities was a cash outflow of $2,421,000. When I look at the data to see where that is primarily coming from, I see it's $1.4 billion from dividends paid, and then the remaining amount is from the difference between the cash payments made on their loans less the cash that they received on new loans. When I scroll down to the bottom of the statement of cash flows, I see the cash and cash equivalents at the end of the year of $616 million. This is the number that I should also see when I go to the balance sheet in the current assets section, cash and equivalents of $616 million. Again, we can see that the company has cash from operating activities. That's positive. The company is currently spending money on capital expenditures to grow or at least maintain the physical assets. The company's cash payments from financing consist mainly of dividend payments to common stockholders and paying down long-term debt. The company spent a net $307 million, but still has over $600 million in cash to start the current year.